David, we seem to have seen some more risk aversion coming into this market Friday, into this morning as well. We had that euro below 123. It seems to be hovering around that level. The rand, though, finding some stability just below 760.
Hi, Stephen. Yeah, the rand continues its impressive run against the euro and against the pound, and holding its own against the dollar, of course. And that's while the euro tumbles and equity markets are looking a little bit shaky on global growth fears. So the rand doing very, very well. This morning we did see it in the Far East break above 760, traded as high just above 765, but has come back quite strongly as equity markets have recovered a little bit, and the euro has moved back marginally above 123.
David, would you have expected the rand to be a little bit weaker considering what's played out over the past week from Southern Europe?
Absolutely, Stephen. I'm surprised at the rand's resilience. It seems that I say this week after week, the rand has done really, really well. I can buy into the euro rand story, but it's done such a lot. Even in just in the month of May, we've moved down from about 980 to sub 930 this morning. Those are really, really big moves, and I don't think they can be justified on the back of what's happening on the global economy.
Of course, we do have that gold price hitting a record high on Friday, going up to almost $1,250 an ounce. So that might be giving some support to the rand. I don't know what you think about that. But other metals prices coming under pressure, and we do rely on the other metals even more than gold.
Yeah, gold needs to be viewed as a currency, Stephen. It's a proxy for what's happening around the world as far as risk aversion is concerned. And other base metals and commodity prices have come off sharply this morning as the global growth story is questioned. Whether we're heading towards a double dip. So there is some divergence as far as gold versus other metals are concerned. And I really think, oil is showing us about global demand. The gold price is showing us about risk appetite in the market. And I really believe that the rand is simply too strong, but probably will remain the darling of the emerging market world, at least until the end of the World Cup, unless we have some dramatic sell-off on equity markets.
At the same time, we do have the Transnet strike. A number of mining companies coming out last week and declaring force majeure on shipments of coal and other minerals that they can't actually get to ports at this stage. Do you think if the Transnet strike continues to drag on, that it could start to have an impact on the rand?
Yeah, I think so, Stephen, from a trade perspective. And of course, there's another domestic event happening this week when the government releases its green paper on land reform. These two things are potentially very risky for the rand, and I think we have to watch them, with some interest. But for the entire year, the market has all but ignored domestic factors in the hunt for yield and the hunt for emerging market exposure.
David, just looking at the stabilization package, which was announced a week ago, last Monday morning, very early, we have seen a very volatile week. Why do you think the market is so dubious about this package? Why have we seen such extreme reactions to it?
Yeah, Stephen, there's many ways to look at it. One might recall that when the US instituted a similar package in 2008 and early 2009, the dollar also took a hit, and as quantitative easing became their their preferred measure of dealing with the crisis. And now, it's akin to throwing somebody a deadline that already can't afford to repay their current liabilities. But a fuel to the fire, in fact, and once the market had a look at this package, realized that, in fact, Southern Europe and perhaps will drag the rest of Europe with it, $1 trillion, $2 trillion, $5 trillion, all you're doing is throwing more debt upon more debt. And that's going to become the issue going forward worldwide, not only for Europe. How do you get out of these debt traps essentially and begin to pay some of these things off? It has to impact growth eventually.
And of course, we did have German Chancellor Angela Merkel this morning saying we were really just delaying or postponing the inevitable here. I mean, is that how you would view it?
Absolutely, Stephen. Certainly for Southern Europe. But there's a whole host of currencies with budget deficits of greater than 10% and debt to GDP ratios are well above 100. So, it is about delaying the inevitable. There are only really two ways that you can fix the problem. You can raise taxes, you can cut spending, both of which have serious impacts on growth. And I think governments around the world are concerned at this point in time, because if you announce serious austerity measures like the Greeks have done, the Spanish have done, the Portuguese have done, you run the risk of upsetting your populace. And if you don't do it, your debt burden just grows ever bigger. So I think we're in for a rough ride, as I alluded to last week.
Of course, so in the meantime, we've had some mildly positive data coming out of the United States on Friday. We had industrial production numbers, retail sales numbers for March as well. And they look to be quite good, but totally overlooked by the market, given the other troubles we're looking at the moment.
Well, that's the point. I think at this point in time, the backward-looking numbers the market is going to ignore, focus on numbers a month or so down the line, and to see what impact these kind of what we've seen in the last week or two, what impact that's had on investor confidence and business confidence going forward, because these are the real issues that we'll have to deal with in the future as the world struggles to come out of a serious recession.
Of course, we're getting inflation data out of the US, out of the Eurozone, out of the UK this week. What do you think that's going to show us? Is it going to show us that inflation is still very benign in those economies, or do you think it starts to become a problem, particularly with this quantitative easing that's being thrown into the European markets?
Stephen, I believe that for the moment inflation is a non-entity, and as part of the Europeans' problem, they keep harping on about price stability, but in fact they've completely ignored asset price deflation up until now, and that's been a serious challenge around the world. Japan has grappled with these issues for over a decade now, so and the US has a better understanding of them perhaps, but I think of the serious threat between inflation and deflation, asset price deflation is with us at the moment, is a really serious threat, and something that we need to take into account is much more serious than inflation at this point.
Well, David, you said we should watch out for that land reform green paper later this week, also the Transnet strike. We also have retail sales coming out on Wednesday. We saw in January and February a contraction of 1.5% in each of those months for the retail sector. Are we looking for break-even or perhaps positive growth for March?
Well, again, I think the numbers looking back will track what's happened globally. I think we'll be marginally flat to slightly positive on the retail sales data domestically. I don't think it really matters at this point in time because we're all but ignoring domestic factors, and I think the focus will remain on Southern Europe and the evolving fiscal crisis.